We're really watching investors want more assets. There's not enough assets for sale for the amount of buyers. We're seeing more scaled transactions, so people trying to buy larger portfolios.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. I'm pleased to be joined today by Chad Lavender, President of Capital Markets for North America at Newmark. Chad leads the overall strategy and revenue growth for the firm's capital markets business across all asset types and is with me today to talk about the state of REITs and capital markets. Chad, welcome to the podcast.
Thank you. Excited to be here.
Chad, at a high level, how would you describe U.S. capital markets activity for REITs and listed real estate today?
It's really property type specific. So you've seen the healthcare REITs really outperform most asset classes over the past couple of years. The ones that are allocated to senior housing are trading at huge premiums to NAV. You've seen them be net acquirers in the market. So we've seen little net selling from them, and they've tried to buy everything that fits their portfolio that they can over the last 24 months. And then if you look at the office sector, you've actually seen the office REITs pretty active on the acquisition front. A lot of them are doing it with JV partners, but they're trying to buy in their core markets at good relative basis and discount to replacement cost. So we're seeing them be pretty active. The retail REITs we've seen active as of late. We've seen everything from them buying a lot of kind of grocery anchored and core assets across the country to the ROIC take private from Blackstone that we advised on. So we've seen a little bit of everything there. Same on the multifamily side. We've seen them sell non-core assets and buy in markets they want to grow or allocate to as well. And then on the industrial front, we're seeing some of the REITs continue to develop and also acquire. We've seen very little selling out of those REITs as of today. And the hotel REITs have been all over the board as of late.
Chad, you've mentioned certain number of sectors there, but are there particular geographic areas that are seeing more activity than others?
Just in general, we've seen, I think in 2016, 35% of acquisitions were in the Sun Belt. That's increased to 47% in the first half of the year this year. Dallas, Houston, Phoenix, Miami have dominated that acquisition activity, but it's really been spread throughout the Sun Belt. So we're seeing that increased focus and interest there. And interestingly, like in the multifamily sector, we're seeing a lot of focus on the Midwest. You have had really resilient rent growth there. Operations are pretty stable and you've had less new supply. So we've seen a lot of activity there.
And drilling down a bit further, can you talk about the different types of capital market activity you're seeing, whether that's recapitalizations, JV deals, privatizations, and how owners and occupiers are making decisions as to which path to take?
It's interesting because every asset class is so different today. There's a lot more scrutiny on the underwriting. Asset classes are coming in and out of favor. Retail's the belle of the ball today, and office is slowly coming back into favor. We've seen institutional bidder pools increase dramatically on the office side and a lot of momentum there. You've seen the top part of the market from a leasing perspective. You have enough leasing activity and you have enough sale comps to kind of validate pricing today. So I think people think that it's oversold in a lot of cases. So there's a lot of good buying opportunities there.
And JV deals have been particularly popular with REITs in recent years. Can you talk a little bit about what makes a successful partnership?
I think it's book matching time and business plan. We've seen a lot of these and we're going to see more. A lot of the long dated capital insurance, pensions, and also other advisors that have capital that matches up to long holds like the REITs, or if REITs are trying to develop, it's not very efficient for them, for the REITs from a dilution perspective. So we see on the development side, a lot of the REITs use capital partners so they don't have to take the dilution.
And do you expect that trend to continue?
Absolutely. It really just levers the REIT's equity to do more business. And also some are JVs where they make promotes. Some are just They're head to head from a return perspective. So we've seen all different types of JVs.
And any particular trends in terms of the partners that they're working with, like sovereign wealth funds? Are they particularly popular right now?
They are. We've seen a lot of sovereign wealth funds out of the Middle East and also Asia that continue to be active and partner with the REITs. We've seen some REITs even raise closed-end funds within the REITs to go deploy equity on the development side. And generally, it's a core strategy with the REIT. So we've seen that trend pick up a little bit as well.
And Chet, can you talk a little bit about what sort of capital market activity you're seeing for alternative real estate assets today?
Yes. I mean, I think 55% of the public REITs NAV are alternative asset classes. And if you look at the Odyssey Index core funds, they're 10 or 12% allocated to alternative asset classes. They want to take their allocations to 50% by 2030. So you're going to see a huge wave of investing in those asset classes. We're already seeing it live today, particularly on the senior housing, MOB, student housing side. We're seeing on the manufactured housing, certainly in the data center side of our business. And like science, we've seen that for years as well.
And what about distressed assets? How much activity are you seeing on that front?
We're seeing quite a bit. There's $2 trillion of debt maturing over the next 3 years, and quite a bit is distress. Most of the answer is typically your current lender is your best lender. So a lot of those lenders are giving their borrowers extensions, and we're seeing the borrowers who are not in good standing or the banks are being constructive in a lot of cases and selling the assets that were on their balance sheets. But we're not seeing a huge wave. We did the $60 billion Signature Bank liquidation on behalf of the FDIC. The amount of liquidity to go buy those loan pools was astounding. And really, there is an insatiable amount to go buy loans. There's just not enough opportunities for the amount of capital raised today.
Well, there's a lot of dry powder on the sidelines.
Absolutely. And certainly on the debt side as well. Tons of liquidity in the market in general.
As you look ahead for 2025 and into 2026, what trends or issues do you think will be the most impactful on capital market activity for REITs?
Yeah, I mean, I think obviously GDP and actual NOI growth solves any issue. So we're really laser focused. You had record absorption, 795,000 units on the multifamily side over the past 12 months. Vacancy rates ticked down 150 basis points to 4.3% nationally. And then you have penetration rates that have gone up to 4%. So you have a larger renter base, a larger percentage of the US population renting, and you have supply that has been delivered over the last 24 months start to be absorbed in a big way. So your rent to own spreads are at an all-time wide today. So your kind of $1,200 spread from renting to own, that spread has historically been $404 for the 10 years prior to 2021. So you're going to see more people continuing to rent, as well as debt levels, as well as cost of debt stays elevated and home prices stay high. So you're going to have a larger renter pool. You have very few deliveries over the next 18 months. So I think you're going to see some upward pressure on rents in 2026 in the multifamily sector. We're certainly seeing it over the past year on the office, the Class A side of office. We've seen these rents continue to trend up, very little new supply. On the retail side, there's virtually nothing getting built. It is performing very well across the country, and it's probably outperformed any asset class, or at least the core asset classes. Then if you look at asset classes like senior housing, you're just entering the baby boomer wave for the age appropriate seniors at 82 plus. And you have this cliff from a demographic side that's going to play out over the next 10 years. And you have very little new supply. And lots of folks, including the public REITs, are projecting double-digit NOI growth for the next 3 years. And I don't see how that doesn't go for 5 years, given no new supply virtually getting built across the country. So we're seeing a lot of great things from a fundamentals perspective. Obviously, the digital infrastructure and data center boom is a modern day gold rush. We're seeing a ton of activity from the hyperscalers, and it's all about power and water. And we're in the middle. I think we did $20.5 billion of those transactions over the last 12 months. We have a lot more we're involved in this year, and the amount of capital deploying that's been raised or trying to deploy in that sector is mind blowing. So it's been a ton of fun, and we kind of have some momentum building across sectors. The advanced manufacturing sector, we're going to see grow quite a bit, and we're going to wait and see and watch how much of this $10 trillion that government officials are saying are going to get invested in the U.S. are going to materialize. But even if a large portion of that happens, it's going to be a very bright future for the commercial real estate industry.
Chad, we've covered lots of ground today, but are there any other issues or trends that you think you'll be paying particular attention to in the months ahead?
I think we're kind of really watching. Investors want more assets. There's not enough assets for sale for the amount of buyers. We're seeing more scaled transactions, so people trying to buy larger portfolios, interested in taking private REITs that they feel are undervalued. So we're seeing a lot of that kind of front-footed activity in scale. And I think we're going to continue to see that over the next 12, 24 months.
It does seem like there's a lot of momentum in the capital markets today for REITs.
Absolutely, there is.
Chad, thanks so much for joining the podcast today.
Thank you for having me. This was a lot of fun, and you guys are a great partner and do great work in our industry. So we appreciate everything you do, and it's fun to get to talk to you today.
Same here. Thanks so much, Chad. And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.